Talk more about the volatility. 314 Research co-founder Warren Pies. Warren, it's good to have you on here. I actually do want to start with you with gold because as we've seen the S&P move lower this week, gold is now outperforming year to date. And I know that's something you and I have talked about in the past.
Yeah, thanks for having me on. This is, from our perspective, I think the setup looks nice for gold here, especially relative to some of the other major assets out there. If you think about it, this is really the fourth time that gold has tried to break out to sustainable new all-time highs. You could go back to August of 2020, March of 2022, right after the Russian invasion of Ukraine, and then earlier this year in May. And the thing that I like about this setup is that each one of those times, speculators in the gold futures market had already really gotten overweight gold at that point in time, each time that gold had crossed 2,000 in the past. And really, I'm not seeing any kind of optimism in the gold market when you look at the futures positioning this time around. So there's a rule in technical analysis. You don't make quadruple tops. You've never heard of such a thing, because once you test a level a fourth time, you break through it. And I look at positioning. I think that this setup here is a good one for gold.
Okay, speaking of technicals, I want to get your thoughts on the S&P and the other averages for that matter, because we do have an S&P that finished at 4117. We're trading in or near correction territory. The NASDAQ composite, similar story in terms of the moves lower we saw this week. The fact that we've fallen below these key levels, what is it going to take to see a more sustainable rally in stocks now?
I think it is as simple as yields, really. If you break down what's really going on in the market, I know you were just talking to Mike about geopolitics. I think that's a factor, but the real issue impacting stocks has been rates, really since the second half of the year. If you measure rates versus the Russell 2000, where we can strip out the mega cap tech influence, there's been a very tight relationship. As rates move higher, Russell 2000 moves lower. As rates move higher, breadth, which is the number of stocks doing well, the number of stocks above their 200-day moving average, for example, has moved lower. So rates have really hollowed out the underlying market structure. It's something we've talked about before, and that puts a ton of pressure on these big cap tech stocks who've been reporting earnings. And if the market dislikes even like the smallest thing in these big cap earnings, it makes the market very vulnerable. So to me, I don't think you can rely, I've been saying this, I don't think you can rely on big cap tech to carry the water for the market any further. You really need a broadening. And in order to get a broadening, you need rates to back up. And I think it's got to be disheartening for the equity investor, the average equity investor, to watch a 10% decline in the stock market, and you really haven't seen rates budge. So to me, I think bonds over stocks for Q4 is still the best positioning.
Hey, Warren, so what is the role of mega cap tech then? Because a lot of these stocks are down at levels where they haven't been for almost 6 months at this point. I guess, stocks, it would have been a better call to not buy stocks when S&P was at 4,600, but some people were saying still buy it then. Now we're close to 4,100. So as we think about where the S&P goes from here, what is the role of mega cap tech?
Well, I think it gives us an important, the earnings is always you get a lot of good information. And I agree again with Mike that there's a lot coming through this big cap tech earnings cycle that shows you that earnings are getting better. But markets are always about what's priced in. And the problem that I have with big cap tech is this: when you have a negative reaction to what's ostensibly a very good earnings cycle. So you can go back to last quarter. If you remember NVIDIA, when they blew the doors off of top line, bottom line, guidance, everything, it was the best quarter anyone had ever seen, and the stock just deflated. And to me, that was a really negative sign for how these stocks have been priced. It tells me that all the good news is already priced into these stocks, and it's really a valuation issue. And I think higher rates, even though higher rates don't impact this group as much operationally, they don't need to go out and borrow money like a small cap does, but it impacts them from a valuation standpoint. So as rates go up, everything, including big cap tech, looks less attractive from a valuation standpoint. So that's where I see big cap tech fitting in.